Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. Today, I am thrilled to be joined by Managing Director and Head of Fixed Income Research, Tom Tzitzouris. Tom, how are you doing today?
Excellent. It's a pleasure to be here.
Yeah, thanks so much for jumping on with us. Usually the volatility in the equity market is what grabs attention, but the equity and the fixed income market has kind of come to the forefront of late. A big reason for that is the Federal Reserve's increasingly hawkish tone and obviously the rate hike and rate hike path that we're going down. So I just wanted to back up high level to start and get your thoughts on what the Fed has laid out and how the market is reacting to it so far.
Yeah, it's a good question. So at this point in time, right now, the Fed has clearly laid out their intent to give us seven total rate hikes this year. They've already given us one, so that would mean six more, and potentially upwards of four more next year. And their ideal target for their Fed funds rate is about a 275 by sometime around September of next year. That's what they're laying out to us right now. And that was pretty clearly spelled out both by Fed Chair Jerome Powell's comments at the FOMC press conference, as well as the dot plot that many investors like to follow. What hasn't been spelled out, but it's been hinted at, is balance sheet reduction. Now, our base case is that the Fed is going to begin balance sheet reduction, make the announcement in May, and begin it shortly thereafter at a pace of 60 billion per month. That is now just being priced in. Now, 60 billion may seem like a lot, but on a $9 trillion balance sheet, that's actually quite a slow pace. But that's where the kind of question mark lies. How fast do they go in reducing the balance sheet, and how long do they go? And do they eventually begin asset sales? Right now, the Fed's not giving us much on that, but you're starting to see the bond market finally price that in. And that's why you're seeing 10-year yields up to about a 240 just a day or so ago, because the bond market's basically pricing in the fact the Fed is going to begin draining liquidity through all portions of the curve, not just raising the Fed funds rate, but reducing the balance sheet as well.
So that's really great context. And you mentioned the long end of the curve rising. But at the same time that that's happening, the yield curve, which is the spread between the short end and the long end, basically, has been flattening pretty substantially and is at a level, at least the 2-year, 10-year curve, where folks are starting to get concerned about the recession potential because it has been historically a great indicator of a looming recession. On the flip side, the 3-month, 10-year spread is still quite wide and quite positive. So this is a bit of a wonky question, but I'm wondering if you could kind of tackle what the dichotomy is there, why the 210 curve is indicating looming recession, but the 3-month, 10-year curve is saying something different, and where you think maybe the mispricing is in that relationship.
Yeah, well, it's just a matter of cherry picking where you want to look at the curve. Each measure tells us a different story. So, for example, when you look at the twos 10 spread, what we like to convey to clients is that's telling you a leading indicator that you're heading towards a recession. In contrast, if you look at, say, a 3-month versus tens, or better yet, a 3-month versus 2-year, that's telling you if you are in a recession. So it gives you no lead time. It's more of a coincident indicator. So what we like to tell clients is when the twos, tens inverts, it tells you the clock is ticking. You are now heading towards a recession. It is not a guarantee. You may have 18 months, you may have 8 months. When the Fed funds rate is higher than the 2-year yield, it tells you you are in the recession now. The clock is no longer ticking. You have entered that recession. So what's happening right now is it's an interesting thing. And Fed Chair Jerome Powell had some comments, which I absolutely would disagree with. He was saying that the 3-month rate is actually lower than really what the 3-month forward rate is. So he's basically saying 3 months versus, we'll say, 2 years. And that spread is widening out. And then the 3-month versus 3 years is getting even wider. Well, that's true. But what the market is doing is the market is saying to the Fed, we believe you. You want to raise the Fed funds rate to 275 basis points by next September. But we believe that is way too high, and you're going to have to reverse course because that will very easily cause a recession. So the market's actually seeing this pricing a rapid liftoff in the Fed funds rate, and then the forward curve's pricing a rapid cut in rates, which is this classic signal of a policy mistake. So it's interesting. Powell is saying this is an endorsement of our path. It's actually an indictment of the path where the market's saying you're going to go too fast.
Interesting. Yeah, and the market now, currently pricing in more rate hikes than the Fed has laid out. I think it was 8 to 9 the last I saw for just 2022 alone. Last question on the long end of the curve. The 10-year. You mentioned that balance sheet reduction could kind of uncap the long end of the curve and potentially steepen the yield curve that we were just talking about. Where do you see as the upside on the 10-year? If we move forward with the balance sheet reduction plan as you kind of laid out a moment ago.
Yeah, and so we've done a lot of work looking at how fast the Fed can reduce the balance sheet based on just simply maturities alone. And it's anywhere from 40 billion to 100 billion a month, but consistently they can only seem to hit about a 60 billion to 80 billion a month, because that's roughly where the average number of maturities are per month. That is a very slow pace. So although that's 60 billion per month is fast enough to move the 10-year yield up gradually here and there, you're still talking about a $9 trillion balance sheet. And of that 60 billion, only about maybe 6 to 8 billion per month of that is 10-year treasury. So the 10-year part of the curve is only going to see net float increasing. We'll round up 10 billion per month on a market which is substantially greater than that. So it's not a huge amount. And so our expectation is if the Fed goes at that pace, 60 billion per month or even less, then you'll see 10s kind of wobble a little bit higher, but really not move much. If they go slower than that, which some have indicated, then you might even see 10-year yields rally lower. Faster than that, it's going to be tough for them to meet, say, an 80 billion per month, because they're going to have to engage in asset sales. That would move the curve much higher and would very likely cause another round of steepening, probably upwards of 30 to 40 basis points of steepening between 2s and 10s, because that is not priced in. The real question mark on pace is, do they ramp up? We think they're going to start at 60 billion per month, but do they say, or do they give a little window to ramp that up later on this year, particularly with asset sales? If that happens, then you're going to see the curve pop higher much more rapidly.
That's great context, and it definitely gives us a lot to watch for at the upcoming Fed meetings as they begin to lay all this out. So, Tom, thanks so much for the time, and we'll be sure to catch up with you later this year as that develops.
My pleasure. Thank you.